Good afternoon. Good afternoon. It's Monday, the 1st of September. Welcome to another edition of Monday Market Picks. My name is Thilan Vikramasinghe. I'm the head of research for Maybank Securities in Singapore. Now, historically, September tends to be one of the worst months for equities. Is that trend going to hold true this year as well? On one hand, we do see some dark clouds emerging with tech sell-offs in the US. And also, we are seeing some political unrest in Indonesia as well as Thailand in our part of the world. But amidst this, Singapore is actually standing quite tall, and we are seeing some very good tailwinds converging together. So that's what we're going to be talking a lot about in today's show. So today's show is really dedicated to tailwinds. First, we'll actually have Brian, an economist, who's going to discuss the latest manufacturing numbers for third quarter and what that actually means for growth. Then we go on to Husseini, who just came back from the investor day at Singtel, and he's actually coming out a lot more optimistic about the stock. We have Jarek joining us to talk to us about ISOTeam, especially after their recent earnings disappointment, and also Marco Polo Marine. Is this a dark horse when it comes to the MAS 5 billion funds? And then we also turn to Indonesia regionally. That's in the spotlight. We've got our analyst Etta joining us to talk to us about why he's still very convicted on GoTo. But let's start with Brian and economics. Brian, welcome to the show. Now, Singapore's manufacturing sector expanded by around 7.1% in July, which is the highest since September 2024. So, where is this slowdown that the street was expecting with US front loading coming to an end? That doesn't seem to have happened.
Yeah. Indeed, if we look at the data for July, it doesn't seem to have happened. Of course, in July, the updated reciprocal tariffs haven't yet kicked in, right? Those kicked in the early part of August, right? But still, right, we saw that manufacturing output expanded by 7.1%. Now, if you exclude the biomedical manufacturing sector, which saw slower growth in July, you would see that industrial production growth actually strengthened to 9.4%. So that's an even better print. So in terms of what's driving the data, we saw very robust electronics demand, right? We saw electronics output surge by 13% from a year ago. And we had certain very bright spots like infocoms and consumer electronics, which expanded by almost 90% year on year due to higher production of server-related products. Yeah, so it's an encouraging start to the third quarter for manufacturing, Dylan.
Yeah, got it. Now, how should we think about growth and trade attractiveness of Singapore? As you said, the new reciprocal tariffs hit in August. So, where
Yeah.
does that leave Singapore?
Yeah, so, well, Singapore is one of the rare few countries that won't see a hike in the tariff rate in August, right? We have been subject to the baseline reciprocal tariff of 10% since April, right? And we will continue to face this 10% tariff rate. And just to point out that our 10% tariff rate is the lowest in Asia, right? Whereas most other US trading partners will suffer tariff hikes in August. And therefore, right, due to the tariff advantage, Singapore could benefit from a diversion in export orders. And I think in addition, it's encouraging that many US trading partners in our region, right, where we serve as an upstream supplier to, so US trading partners in ASEAN and also Northeast Asia like Japan and Korea, they have secured relatively lower US tariffs, at least compared to what was announced on Liberation Day. And this supports regional trade volumes. So while we could still see a slowdown in global trade, right, when higher tariffs kick in the third quarter, but ultimately, given these advantages, right, Singapore's own tariff advantage, as well as the relatively forgiving tariffs for key US trading partners in the region, this should actually limit the severity of any export slowdown in the second half.
Got it. Now, you've got a 3.2% GDP growth number for 2025. Now, this is much higher than the government's own forecast, which is ranging from 1.5% to 2.5%. So, why are you so bullish? And are there any more upside risks to these numbers?
Yeah, regarding exports, so other than the tariff advantage, I think the other tailwind, right, that we are still seeing in a very strong way is the AI and also data center boom, right? We have rapidly growing demand for AI computing power globally, which has supercharged demand for servers, semiconductors, and related machinery. Now, not to forget that electronics industry actually makes up almost 40% of Singapore's manufacturing output, and the bulk of which constitute semiconductors. So Singapore is benefiting from this rapidly growing AI demand, right? And we think that with electronic products exempted from US tariffs, demand will likely continue growing in the second half. So this is another reason for why we think that Singapore's exports should remain quite resilient in the second half. I think in addition to that, other non-trade related indicators, right? So including financial and property transactions remain robust in July. And this suggests resilient GDP growth in the third quarter, right? So monetary conditions are easing as interest rates fall rapidly. The SORA rate is still dropping day to day. And this is supporting property and also financial and trading activities. I think other than that, we have a multi-year construction boom that's driven by mega projects, including Changi Terminal 5, Tuas Megaport, and also HDB housing projects, as well as the expansion of our integrated resorts. Yeah, so we have these multiple engine drivers for the Singapore economy. 3.2%, it may be higher than MTI's forecast, and it may be higher than most of the street's forecast. But not to forget that even our 3.2% forecast factors a significant slowdown to 2.3% GDP growth in the second half, as compared to 4.3% in the first half. So therefore, we still think that even with our forecast of 3.2%, there could be further upside from here.
Okay, good to hear. Thanks, Brian, for joining us. So a lot more growth for Singapore on the upside, so watch out for that. Now, with that, let's go into equities and turn to Hussaini. Hussaini, welcome to the show. And you attended the Singtel Investor Day last week. And you say you actually came away a lot more optimistic about the business. Now, this is a stock that you already have a buy on. So maybe can you share your main three takeaways?
Yeah, sure. Thanks, Silan, for having me. We came out really constructive from the Singtel's Investor Day. And here are my three key takeaways. First, a fair bit clarity on capital management. So management noted that there are multiple areas of asset monetization or value elimination. And on the back of that, they can keep payout ratio high till FY 2030. So for the next 5 years, they are kind of indicating that they can keep the dividend levels high on the back of all those initiatives. And on top of that, they have earmarked $2 billion for share buybacks. And this has not yet commenced. So even if the stock price has gone up, what company is indicating that they have ammunitions to keep the yield competitive. So this is the first key takeaway. Second is in Australia, their Optus business. Now it is shaping up really well. Rising consumer confidence in Australia is driving a positive demand environment, and in turn allows for postpaid price increases without much resistance. Management also noted that given their positive momentum on the revenue side and ongoing cost rationalization, it can drive margins from 27% last year to mid 30s over the medium term. in the next 3 to 5 years. So quite a bit of tailwinds coming from Australia. And finally, uh, is the digital infraco business, which houses data centers as well as GPU as a service, or we can call it AI related business. Now here in the data center side, demand remains strong, particularly for Singtel, because they have the track record, they have the hyper-connected data centers, and they have demonstrated that they can run very high density racks vis-a-vis other providers in Singapore, data center providers in Singapore. Now, even for their upcoming data centers, which they have yet to ramp up, they have already pre-sold 50 to 80% of those capacities. In fact, for their upcoming data center in Thailand, for which they have not yet broke the ground, they have sold more than 30% of the capacities. Uh, on the AI side, companies also quite positive on the GPU as a service. So till last year, they were mainly in experimentation phase. Now, as they have successfully surpassed that proof of concept, they are going to deploy that at scale. So net, we came very positive, and those are the three key takeaways.
Got it. And then just finally, remind us what your overall investment thesis for Singtel is.
Yeah, so we remain a buy on this name. Thilan, if you look at my last few reports, uh, I was highlighting that out of Singtel's 8 operating units, i.e., 4 core businesses and 4 associates, 3 businesses were facing some challenges. They were Singapore Mobile and Telkomsel in Indonesia and Globe in Philippines. Now we can comfortably say that even these 3 businesses are seeing positive tailwinds. So in Singapore, with M1 and Simba consolidation, expectation is that the competition should improve. And in Indonesia, all the 3 telcos have raised prices starting March of this year. And on the back of that, even we met Telkomsel in the Central Investor Day, and they were guiding for a better second half. Similarly, in Philippines, Globe posted a better a better second quarter results earlier earlier last month, and in the management was highlighting that going into second half and next year, they expect to see positive momentum. So net of all the 8 business units of Singtel, we see either they remain in a very strong position or we see areas of improvement. And on the back of that, we remain positive on the name.
Okay. Now, very quickly before I let you go, I've got a question from YL here who's asking, will Simba be a potential threat to Singtel?
No, I don't think so. See, there are multiple things to take note here. First is that Simba, when they acquire M1, their leverage levels will go really high, almost 4 times net debt to EBITDA. And that to an extent will constrain their ability to be as aggressive as they were in the past. Second is that with M1, see, all these years, Simba has just started from the scratch. They didn't have any legacy revenues or any form of revenues to defend. Now with M1 acquisition, they will have some part of M1 revenues to defend. That will curtail their ability to be as aggressive as they were in the past. And also to note is that Singapore prices have come down quite significantly, right? So the ROIC levels are quite challenged for the incumbent operators. I am of the view that to an extent will be the case for Simba as well post M1 acquisition. And most importantly, if we look at consolidation across the globe in the last 4 or 5 years, or in fact in the last 10 years, in all the markets post consolidation, industry revenue growth improves. Okay, and in most of the markets, the bigger beneficiary of the consolidation is the spectators, not the consolidator itself. Okay, so given all these factors, we are of the view that industry should improve. The growth momentum in the industry should improve. It had been under quite a bit of pressure for the last many years, and I don't see much risk for Singtel or startup. I'm of the view that they could be the potential beneficiaries.
Okay, thanks Husseini for that. With that, let's go over to Indonesia and let's talk about GoTo. Eta's on the line with us. Eta, welcome to the show. Now, GoTo's first half numbers were within expectations. What were your main takeaways?
Okay, for GoTo, number one is the GTV growth. It went up by 13% within the company's target. We expect the growth is about 11% this year, and I think it's still potentially achievable if the second half economic growth improving. And second, related to the fintech business is still expanding as expected, especially on the lending side, which have a higher margin. Their gross net interest is about 4%. And then third one is related to the adjusted EBITDA target, which remain on track. So basically, in terms of operational, still within expectation, management managed to control costs and achieving its on track on adjusted EBITDA target. So the result is satisfying for us at the moment.
Okay, and then you got a pretty satisfying looking target price as well, nearly double
Yes.
the current share price. What's driving your conviction there, Eta?
So basically, we still believe that the GTV can improve higher than the GDP because the target market for on-demand services is the premium customer, which supposedly have a better resilience during the economic challenges. And second, related to the lending business, we have an opportunity here with the middle to low segment is feeling the pressure from the economic slowdown. So I think there is an opportunity for loan growth there. And thirdly, the cost saving, I think management will continue to implement cost cutting, especially on the data center and related tech costs by migrating to the China vendor, and if this to sustain the profitability. So I think on business level itself, Indonesia is a duopoly market practically on the on-demand as well as the food delivery with Shopee still lag behind. And I think their competition unlikely there is a new player in the short term during this kind of industry consolidation. So in terms of profitability, I think it is irrational if there's price competition. So I think it's about time for both company to do the profitable business, reduce the excessive marketing expenses. That's why we believe that this industry is still have positive outlook from growth as well as from the better profitability.
Okay, got it. Now, Eta, you're on the ground in Jakarta right now, so can you give
Yes.
us a quick update on what's happening there, and also how will this actually impact your thesis on GoTo?
So basically, we have a political situation here hit up. So, but this is only on selected areas, not all across Jakarta. So business for food delivery as well of the or e-commerce still run normally, as the protest is usually escalate during the night while the business is on daylight. So I think uh, it might have impact in selected areas, but how can it escalate is subject how the government contain this political issue. So we are hoping that this can be solved quickly, and we are expecting that in terms of business, it's not affecting significantly for GoTo as well as for Grab. Mainly as we believe that the current still the government can control the current situation for the moment.
Got it. Okay, thanks so much, Eta, for joining us, and stay
Thank you.
safe. Now let's turn to Jarek, and let's start with ISOTeam. They reported FY25 earnings last week, and the numbers were generally a little bit disappointing. Jarek, what were the key drivers behind this?
Hi, Thilan. Yeah, so basically, I think the key thing was firstly is that, because of the elections, there was some rezoning, and a lot of their R&R projects, as a result, got delayed by this rezoning of different areas. And that led to also delay in recognition. So if you look at the results, actually R&R revenue dropped by close to 40% year on year. So that is mainly due to the rezoning and mainly due to the recognition. But we do think that all this will likely come into their first half next year instead. I think they announced quite a few contract wins right after that as well. So we do think that all these R&R delayed projects will then kick into their first half next year. So we do expect first half to also rebound strongly as compared to second half last year. And
Got
also,
it.
lastly, is also on the tax credits as well. So they were able to claim quite a lot of tax credits in the first half last year. But if you look at tax credits wise in the second half last year, they actually paid about 1+ million of tax to the government. But I think during COVID, they lost a lot of money, so they still have a lot of tax credits to be used. And I think it's more of there's a maximum limit they can use every year. So we also expect that to likely be lower for first half of 2026 for the tax credit,
Okay.
for the tax rise, yeah.
Got it. Now, stock's already given up quite a bit. It's down about 17% in the past month. Is this the time to buy the dip, or do you think there is, the investors can wait a bit more?
I think they can wait and see, but we do think that they'll likely rebound quite strongly in the first half next year. So if investors are quite light on this, they can actually add some. But if they really have the stock, then they can actually wait and see before they add some. We are still bullish on the stock. I think that we are expecting, with their order book of 181 million, we are expecting them to do better next year, especially in the first half. But this company has a lot of execution risk, so we still have to see whether their first half numbers do add up or not, and how do they execute all these projects. But if they were to do it well, then the stock price will continue to perform. So we do think that investors that have shares already can wait and see, but investors who are light on this could probably add some.
Okay, got it. Now, also want to touch on Marco Polo Marine, which is getting some attention as a potential beneficiary of the MAS $5 billion dollar scheme as well. They just announced that they're going to list one of their subsidiaries in Taiwan. Can you take us through the transaction, and do you think that's a positive step that they're doing?
Sure, I think I think that's a very positive step because they are 49% listed subsidiary PKRO, which is mainly doing the Taiwan offshore wind farm chartering. They are actually doing very well, and the CSOV has really been set sail for about 3-4 months now, and it's very stable. And the second half of CSOV calendar looks to be almost completely filled as well, and also is filled with higher charter rates from Siemens Gamesa as well. And so we do think that earnings for PKRO was gradually pick up quite strongly over the next 1 to 2 years, and they are already booked for 3 years of charter, so that won't be a problem. And I think there's also plans to expand the fleet. So if you look at Taiwanese valuations as compared to Singapore valuations for offshore wind farm, I mean Marco Polo is trading at about 8-9 times PE. In Taiwan, they are all trading at 20 to 30 times PE because I would say Taiwan is the epicenter for offshore wind farms. A lot of projects are all around there, so the people there value this, I would say, this industry much better than Singaporeans, especially after the oil and gas crisis. So we do think that listing in Taiwan gives them less dilution because they are able to raise money at a much higher valuation than Singapore, and this will also allow them to then firstly expand their fleet through equity raising and also through debt financing, because over there's a lot more green bonds for this offshore wind farm sector, and the banks there are more willing to lend to this sector as compared to that of Singapore banks and Malaysia banks. So we do think that they'll benefit on two fronts. One, the equity raising should be at a much higher price, and also debt financing will be cheaper and easier.
Got it. And why is this stock a buy?
Basically, if you look at, I mean, third quarter, we think it's their worst quarter already. I mean, third quarter rebounded strongly from second quarter, but fourth quarter will be stronger than third quarter. Traditionally, third quarter has always been seasonally the strongest quarter, but this year, because their utilization has been so low, so fourth quarter will be stronger than third quarter. We think that utilization will roughly be around 75% and then pick up to close to 80% next year. They are also in the midst of securing some long-term charters that will also help to add some stability to their earnings. So we do think that third quarter is the bottom, and going forward results will be much better.
Okay, so do have a look at Jarek's report in our newsletter today. Thanks, Jarek. Now, before I let you go, before I let the audience go, I just want to answer a question from Andrew Lim, who's asking, local rates have dropped significantly and S-REITs have gained, but are still way off levels seen in 21-22. Are we due for a more meaningful re-rating? Yeah, so I think Krishna is very, very positive on the REIT sector right now, given the fact that SORA rates have collapsed in Singapore. That's actually opened up the spread between the risk-free rate as well as the dividend yield for the sector. And if you actually look at the past reporting season, more than half of REITs actually saw DPU growth. So that's a positive sign. And we also saw that their funding costs are coming off quite quickly as well. So every 50 basis point fall in funding costs. That's about 3 percentage points to the DPU. So something to watch out for as we go into the second half. We have top three picks in the REIT sector: CICT, MLT, as well as Capital and Ascot Trust. All of them very attractive yields, as well as good liquidity as well. And we think that Capital and Ascot Trust might actually be a beneficiary of the MAS funds as well. So do have a look at those names as well. With that, unfortunately, we are out of time. Just want to highlight Lion Global's short duration bond fund. They have a presentation for investors on the 4th of September at our offices. Do please sign up for that. With that, unfortunately, we are out of time. Thank you so much for joining us and have a profitable trading week.